Good morning, good afternoon, or simply good day from wherever you're joining us. Thank you for being with us for the fifth and final webinar in the series of the BAF Future Leaders class of 2026, the 11th class of the program. I'm Daniel Pino, and I oversee the BAF Future Leaders program. This webinar series was designed to give project teams an opportunity to take a deeper look at their white papers that they presented at the BAF Global Annual Meeting. We're grateful for the strong interest and engagement the series has generated so far. Just a couple webinar reminders. Everyone is muted to reduce any noise or distraction during the presentation. Video is also turned off for everyone except our speakers. This webinar recording will be posted after the session. If you want to ask some questions, some screen navigation options, you can please use the Q&A to submit your questions. You can also raise your hand under the reaction box if you want to ask your question verbally. And we will unmute you at the end during the Q&A session. Today's webinar will focus on practical uses of digital assets in transaction banking, a white paper, which outlines how digital assets such as stablecoins, tokenized deposits, and central bank digital currencies, CDBC, are transforming financial infrastructure, settlement process, and liquidity management. Each year, BAF councils submit potential topics, and the board select those that the future leader develop into white papers. The team's white paper is available free of charge to BAF members in the online store under Member Tools and Future Leader white papers. You should have received a link to download the registration with the registration, but I'll also post the link on the chat. Before we begin, I'd like to note that the applications for the 12th class of the BAF Future Leader program will open in early August. Candidates must be nominated by their BAF member organization, and the application link will be sent to each organization's primary contact. If you have any questions about the program, please feel free to reach out to me. And without further ado, I'll transfer over to the team. Thank you very much.
Thank you, Danielle. I'll start. My name is Dana Gordon. I work at Citi. I've been at Citi for about 7, going on 8 years now, working in Treasury and Trade Solutions, covering banks and broker dealers. Unfortunately, Tyler was unable to make it today, but he works for Deloitte and he did a lot of work on our survey specifically.
Hello, everyone. My name is Sergey Maslenikov. I'm a relationship manager working for BNY and based in our London office. I'm responsible for a portfolio of FI client relationships across Eurasia within our global payment and trade division. I've been with the bank for 5 years, and I'm pleased to join you all here today.
Hi, everyone. Max Chin from Standard Chartered. I'm part of the transaction banking corporate sales team here. This is my 10th year with the bank. Started off in the Bank Singapore office covering ASEAN markets and moved over to our US office where I'm currently based in San Francisco, covering the tech, media, and telecom sector. Pleasure to be here.
Hi, everyone. I'm Nico Donke from ZKB, based in Zurich. I'm working in the network management team, and I'm responsible for Swift products that we use inside the bank. Pleasure to be here.
Hi, everyone. David John Diaz here. I'm part of Banco Santander, working in the global core trade team based in Boadilla in Madrid. And I'm responsible for US, Peru, Asia, and the US inside the traditional core trade products of the bank. So guarantees, letters of credit, and trade loans. So very nice to see you all here.
Hi, everyone. My name's Tom Vesti. I'm a sales director at Danske Bank in Copenhagen, and I work within transaction banking. I look after our cash clearing sales business, which is our effectively correspondent banking product at Danske Bank. And it's a pleasure to be here today.
Last but not least, hi everyone. My name is German Slapins, and I'm a relationship manager for financial institutions at UBS. I'm based in Zurich and covering international financial institutions that are based outside of Switzerland. Been with UBS for 4 years, and prior to that, I was with HSBC in London for another 4 years. So, on that note, thank you, team, for your great introductions, and hope you liked our pictures taken in front of our beautiful financial institutions. Today, I have the privilege to open up our project. So welcome everyone to the Future Leaders session on practical uses of digital assets in transaction banking. Digital assets is an important topic that is widely discussed and is featured in many conversations and sessions at BAFT. What makes this topic especially important is that digital assets are no longer just being discussed as a new asset class or a niche innovation. Increasingly, they're becoming a conversation about financial infrastructure itself, about how money moves, how settlement happens, and how banks can manage liquidity more efficiently in a more digital and faster-paced world. What we found is that this is no longer a question of whether digital assets are relevant, but where they're becoming practical first. We are 8 practitioners from 8 different institutions spread across geographies, and over the last 6 months, we've done one thing: cut through all the noise surrounding the topic. We produced a paper answering one question: what do digital assets actually mean for transaction banking? Not in theory, but in operations and client outcomes, right now. We went deep on research, spoke with industry experts, and surveyed financial institutions, including the ones represented in this webinar today. What we'll share today is practical, where value is real, where barriers still exist, and where banks can act with confidence. Our goal today is to make this topic concrete, where the use cases are emerging, why they matter, and what still needs to happen before they scale. What became clear to us through this work is that the real story here is not hype. It's not about crypto and so on. It is the gradual modernization of transaction banking infrastructure, especially in payments, liquidity, and settlement. I am now handing over to my colleague Nico, who will walk you through what our research has revealed.
Thank you, Germans. To start with the presentation, I want to give you 3 things that we found. The first thing is the baseline. I mean, it may seem from the outside that stablecoins and tokenized deposits are the same, but they are not. They have different differences. For example, stablecoin is open loop, and tokenized deposits are closed loop. In this case, open loop means practically everybody can participate in trading stablecoins, if you have a wallet, for example. And closed loop means the participants are usually only one organization. The second one is risk-based. So tokenized deposits are already in the balance sheet because they are backed by the funds that are already in the banks. And stablecoins, they have the risk of the issuer because they are backed at the issuer. And if you understand this as an organization, then you have an advantage of the rest of the pack. The second thing I want to point out is digital assets will not displace corresponding banking at the moment and in the foreseeable future, but they will challenge the traditional rails. What do I mean by that? Digital assets will start to evolve where friction, cost, and is high, and the fees are high, and the clients are looking for cheaper substitutions. So, for example, if you are in an emerging market and you have a very high inflation within your currency, you may want to go to stable coins to keep your value of your own money. That is one use case that can be used for. correspondence banking as it is, and for example, Swift network and Nostro and Vostro clients will stay as they are at the moment when they are fast and cheap. And this is what we see at the moment. Swift, for example, is trying to be to get cheaper and get more get faster. And the third thing that we found out is in trade finance, the market tried to digitize itself a couple of times already, and as of now, it always failed. But this was not due to the technology itself, but it was due to the lack of regulation and to the lack of coordination within the industry. This starts to change now. We have now a couple legislations that already have a regulation for digitized trade finance products and documents, and we see that the markets are adapting to this. So what does this mean for you as an institution? If you want to be relevant in the future, you should engage in these developments. Otherwise, you are forced to follow your competitors did. And with this, I would like hand over to my colleague Tom, who will give you some hard facts around digital assets.
Thanks, Nico. So, as you can see here, I want to talk about some of the key challenges and realities that are already upon us today in transaction banking. And you can see 4 boxes, 4 key areas that I want to talk about. And these are the 4 key areas that we actually focus on in our paper. And the first one is the orange box, which illustrates liquidity. So it's estimated that there is around 27 trillion sitting idle in pre-funded Nostro Vostro accounts globally. And that's enormous amounts of capital that is effectively sitting idle. And it's there because it's there to ensure that payments can settle across different time zones and different currencies and via different systems. And this is expensive because it could be invested in a far more productive way by banks. So this is one of the core arguments that we make in our paper when we say that the true cost of cross-border payments is very closely tied to liquidity costs and liquidity timing. And you can say that the system that we have in place today works, but it works by holding these enormous excess liquidity balances in Vostro and Nostro accounts as insurance against delay and uncertainty. So the question becomes, if the settlement can happen faster, more precisely, then how much of that 27 trillion could actually be released back into productive use? The second one is in the green box that you can see, and this talks about regulation. Now, we have more than 10 major jurisdictions live with digital asset frameworks today. For example, MiCA, now fully operational in the EU. We have the Genius Act signed in the US, and we're seeing similar regimes pop up in other major jurisdictions like the UK, Singapore, Japan, for example. So the argument that we heard some years back has now kind of died out, that it's waiting for regulatory clarity or we want to see what happens. That's effectively past now, because there is a defined supervised playing field for the banks when it comes to digital assets. And this has shifted things, I would say, quite fundamentally when it comes to the regulation piece. It's no longer about how banks will engage with digital assets, but how they will engage in a way that is in line to their internal appetite and also in line with regulatory expectations. And this, again, is another one of the key points in our paper, that this conversation is moving from a conceptual one to more implementation and operating model one. The third is trade finance. So there is an estimated 1.5 trillion, in some cases even more, up to 2.5 trillion estimated trade finance gap globally. And that represents unmet demand every year from real clients and real transactions that are not being financed. So it's quite clear that there is not a lack in trade activity, but rather still persistent challenges that exist with timing, with liquidity and risk management. And this is linked to one of the key lessons in our paper again, which is around that we've already seen attempts to digitize trade So platforms like Marco Polo, WeTrade, Contour, and yes, they did help to improve the document handling, but they didn't fundamentally change when the liquidity is moved. And that's a critical distinction, I think, because the value sits not just in digitizing the documents, but actually linking real trade events with funding and settlement directly. The fourth box here is the central banks. So we now have more than 10 wholesale central bank pilots globally. Helvetia, you might have heard of Dunbar, Mariana, Agora. And what's important here is to note that it's not just the number of pilot cases, but it's more what they are trying to achieve. And they're targeting the same challenges that we deal with on a day-to-day basis in transaction banking. And that's settlement finality, cross-border coordination, liquidity efficiency. So I think more in general, this does signal that also central banks are evolving in parallel with what the banks are doing. And then just to touch upon some of these other boxes that you can see at the bottom, and I think one really interesting one is that, the stable coin transaction volume is already mass at scale, in some cases exceeding the traditional card network. So the question is no longer whether these models will become used, because they already are, and Nico gave an example of how. But I think the real question now is how does digital assets actually integrate into regulated banking environment, and where can they deliver tangible improvements for our clients? And I think as adoption continues building and those use cases will become clearer, and innovation will naturally accelerate those. So in conclusion then, this is really putting all this together. What our paper explores is the opportunity that surrounds digital assets if we get this right, but also the risk if we simply create fragmentation in a digital form. And to get this right, it will require coordination between the banks. Otherwise, we do risk creating different platforms, token models, rule books, which ultimately lead to the same underlying inefficiencies. And with that, I will hand over to Gamans, who will take us through our survey results that we conducted.
Sure. Thank you, Tom. And I will now continue with the survey results. We have surveyed financial institutions that took part at the European BAFT conference in London. And the results are quite significant. Key takeaway is that digital assets are already on the agenda for most banks, but still largely at early stages. 92% said their banks already have or currently developing digital asset strategy. Around half of institutions are actively running pilots. And if you combine institutions which already have active solutions, running pilots, or proof of concepts, the number is striking 86%. 83% said they plan to increase investments in digital assets in the next 24 months. This really highlights that the industry is not debating if anymore, but rather how and when to scale. At the same time, the main constraints are not the technology itself, but regulatory uncertainty, risk and compliance requirements, and also integration complexity. In terms of where banks see real value, the priorities are very clear. Stablecoin-based cross-border payments and tokenized deposits rank as the most relevant near-term use cases. Importantly, adoption is being driven primarily by client demand and the need to improve operational efficiency, rather than pure cost reduction. This is a critical shift. It shows that digital assets are increasingly seen as a way to enhance core transaction banking capabilities, especially around settlement speed, liquidity management, and client experience. Strategically, these results suggest that digital assets are moving from experimentation to competitive positioning. For banks, the implication is clear. The priority is no longer simply to monitor the space, but to decide where to build capabilities, where to partner, and how to prepare infrastructure governance and client propositions for a more digital form of money and settlement. On this note, I'll hand over to Dana to continue with a deeper dive into where digital assets can create real value.
Thank you, Germán. While we were examining the practical use cases of digital assets in transaction banking, Our research identified 4 key areas where digital assets can solve for real-world pain points. For my section today, I'll be focusing on the first 2 listed here on the slide: payments and cash management, and collateral and liquidity. Starting with payments and cash management, the key question we asked was, why are Nostro balances sitting idle overnight? Today, as Tom mentioned earlier, roughly $27 trillion sits trapped in pre-funded correspondent banking accounts simply to support future payment obligations. That's an enormous amount of liquidity sitting idle instead of being deployed productively. Digital assets, specifically stablecoins and tokenized deposits, give us a path to fundamentally improve that model. By enabling 24/7 PVP settlement and near real-time FX, banks can reduce the operational drag created by cutoff times, reconciliation delays, and pre-funding requirements. What's important here is that we're not talking about replacing correspondent banking overnight. We're talking about improving it corridor by corridor, especially in places where friction, liquidity costs, and settlement delays are at their highest. The opportunity is really about liquidity optimization and operational efficiency. And it's no longer theoretical. Institutions like JP Morgan, Citi, HSBC, and BNY are already live today with tokenized deposit solutions, processing real transaction flows. Our research found more than $1 billion per day is already moving through tokenized deposit networks. One of the most important industry initiatives in this space is Project Agora. What makes Agora especially significant is that it's not just testing digital assets in isolation. It's testing whether regulated commercial bank money and central bank money can operate together on a shared programmable infrastructure for cross-border payments. That matters because one of the biggest risks in the industry is fragmentation. If every bank builds its own closed ecosystem, we're simply recreating today's inefficiencies in a digital format. But projects like Agora are trying to solve interoperability and governance upfront, which is exactly what the industry will need to achieve scale. The second area is collateral and liquidity. The question here is, why can't collateral move intraday as quickly as markets move? Today, collateral substitution and mobilization are still highly operationally intensive, often dependent on batch processing and legacy infrastructure. That creates trapped liquidity, increased settlement risk, and unnecessary intraday credit usage. Tokenized collateral changes this by enabling atomic DBP settlement. In simple terms, the asset and the payment will settle simultaneously, reducing principal risk and allowing near real-time collateral movement and substitution. This creates meaningful operational benefits for banks and market participants. Faster settlement, improved collateral velocity, lower liquidity buffers, and reduced settlement fails. Project Helvetia is one of the strongest examples of this concept already being tested in practice. The Swiss National Bank and SIX Digital Exchange use wholesale CBDCs to settle tokenized assets on distributed ledger infrastructure. The goal was very straightforward: determine whether tokenized securities and central bank money can deliver safe and more efficient settlement models. Most importantly, these projects demonstrate that the conversation around digital assets is evolving. The focus is shifting away from speculation towards infrastructure modernization, improving settlement finality, liquidity management, and operational resilience within transaction banking. Ultimately, the technology is no longer the main question. The bigger challenge now is interoperability, governance, and regulatory coordination. But the direction of travel is increasingly clear. Digital assets are beginning to create tangible value in transaction banking, where liquidity, settlement, and operational friction are most expensive. And now I'll turn it over to Max, who will walk you through points 3 and 4.
Thanks, Dana. On to Treasury and Trade Finance, points 3 and 4. These are 2 key areas that are particularly relevant to many of us here today. One of the observations from our research is that digital assets indeed create value when they solve existing business problems. As mentioned by Dana, technology itself is not the objective. It's not the end goal. The objective here is to improve efficiency, to reduce risk, and deliver better outcomes for clients. Let me start with Treasury. For many corporates and financial institutions today, Treasury management remains surprisingly fragmented. Liquidity is often spread across multiple entities, currencies, and jurisdictions. Visibility is often delayed, and cash can become trapped across the organization. This is where digital assets are beginning to demonstrate practical value. Tokenized deposits, wholesale CBDCs, and other programmable settlement assets do have the potential to enable more real-time visibility and movement of value across entities and markets. Just as an example, in the United States, the Genius Act reinforces the trend towards regulated digital money through a supervised framework for payment stablecoins. Together with the development of tokenized deposits by commercial banks, this reflects the broader direction towards regulated forms of digital settlement. Importantly, this is no longer theoretical. Banks have moved beyond proof of concept and are deploying tokenized deposit capabilities in selected markets and in use cases. Similarly, from a country perspective, we have Hong Kong, just an example, where they have Project Ensemble, which is exploring tokenized deposits and settlement infrastructure. In Singapore, Project Guardian has demonstrated how tokenized assets and liabilities can interact within regulated financial markets. For multinational corporates, this could fundamentally change liquidity management. And our research suggests that Treasury may actually be one of the most commercially mature digital asset use cases today, because the benefits are tangible, measurable, and relatively easy to quantify. Turning on to trade finance. And we've heard this for a long time. Trade finance has spent decades trying to solve the same challenges. Paper, manual processing, long cycle times, and operational risks. The industry often jumps directly to tokenization. But one of our key conclusions here was that digitization is as important, if not more important, than tokenization. Before we tokenize trade assets, we first need to digitize the underlying document layer. In many respects, the electronic trade documents are themselves digital assets. The difference is that they are legally enforceable and solve a problem that the industry already understands. Today, as we know it, the bill of lading remains a physical document in many of the trade corridors. Documents continue to move between parties, introducing delays and operational inefficiencies. Banks still manually check presentations, discrepancies remain common, and financing can be delayed while documents move through the trade ecosystem. The encouraging development is that the legal infrastructure is catching up. We have frameworks such as the UK's Electronic Trade Documents Act, UN's Model Law on Electronic Transferable Records, the adoption in various jurisdictions, and ICC rules such as EUCPA. These are creating legal foundations for electronic trade documents and electronic transferable records. Now, once that foundation exists, additional opportunities would emerge. One example in our paper is the collaboration between Banco Inter Chainlink, Central Bank of Brazil, Hong Kong Monetary Authority, Standard Chartered, and Global Shipment Business Network. This was a pilot that connected Brazil's DREX infrastructure with Hong Kong's Project Ensemble ecosystem to simulate cross-border trade finance flows. Now, what makes this interesting is not the blockchain itself. It is the ability to increasingly synchronize trade documentation, title transfer, and payment settlement. Instead of moving documents, goods, and money through separate processes, these elements can become more connected. We also looked at smart contract-based workflow automation. And in our view, the most realistic use case is not fully autonomous trade finance, but rather automating repetitive and rules-based processes such as document validation, workflow triggers, and audit trails. This can reduce manual intervention, improve straight-through processing, and shorten timelines while maintaining appropriate human oversight. So where do we go from here? Really, our paper makes 3 recommendations. And of course, the paper goes into detail. The first, to digitize before tokenizing, where we have electronic trade documents, structured data, and workflow automation. These create value regardless of whether tokenization is ultimately adopted. The second, to focus on corridor-based adoption. We know that progress is most likely to occur when regulators, legal framework, and market participants are already aligned. The third, to prioritize interoperability. The industry should avoid creating a new generation of digital silos, and long-term success will depend on connectivity across platforms, institutions, and jurisdictions. I'll end with one final thought. When we started this research, we expected the discussion to be about technology. But what we found is that technology is becoming the so-called easier part of the equation. Right? The harder questions are around legal frameworks, interoperability, and you hear this mentioned a couple of times, governance and industry adoption. Digital assets are not a destination in themselves. They are simply another tool to make transaction banking faster, safer, and more efficient. Thank you for your time, and we look forward to Q&A with Sergey and David.
Thank you, team. I see a hand raised. Melanie Bailey, we're going to allow you to ask the question. You can unmute yourself, Melanie, and ask your question. Hello?
Hello?
Yes, we can hear you.
I'm sorry. My apologies. I didn't mean to raise my hand. That was a mistake. I don't have any questions right now. Great presentation.
Okay, team, you can address some of the questions that came in.
Sure. Thank you. Thank you, Max. Thank you, Daniel. Thank you, team. I've been looking at the questions coming in, so I will take a couple of questions that are relating to the use of digital assets and payments, and then I will pass over to my colleague David to address some of the questions relating to the use of digital assets in trade finance. So the first question that came in was, and I'll read it out. What are some specific challenges and constraints for digital assets? Thank you for the question. So what we found in our research is that the biggest challenges are not really about the technology. The technology is there, and it's good. They are about regulation, legal certainty, interoperability, and operating models that are implemented. As we say in our white paper, the first constraint is regulatory fragmentation. A model that works in one jurisdiction might be restricted in another, and especially around stable coins, tokenized deposits, reserve rules, and licensing. Second is interoperability. Without shared standards, digital assets can recreate the same fragmentation that they're supposed to be solving. So we also found that operational and risk issues become more important, not less. Smart contracts, key management, cyber risk, governance and settlement, finality all become critical control points. And in trade finance, especially, human judgment still matters for sanctions, fraud, discrepancies, etc. So the conclusion of our research is that scale will depend less on the technical feasibility and more on whether institutions can build legally enforceable, regulated, and interoperable models with right governance and controls in place. And I will answer the second question, which is related to the first one. How have regulation and supervisory expectations changed the conversation around digital assets for banks? Again, what we found is that the conversation has shifted quite materially. A few years ago, the discussion was mostly about whether the banks should have any exposure to digital assets at all, and today it's now the conversation is much more about which digital assets models can operate inside a regulated perimeter and under what controls. As we say in the white paper, regulation in major jurisdictions has moved from policy debate into implementations now. We point to MiCA in EU, the Genius Act in US, and stablecoin regimes in places like Singapore, Hong Kong, UAE, as examples of that shift. So the focus is no longer just headline crypto risk. It is now reserve quality, redemption rights, licensing, IML controls and standards, sanctions controls, just to name a few. The conclusion is that this does reduce some uncertainty, but it does not eliminate risk. In fact, supervisory expectations are becoming more specific in some ways, more demanding. So for banks, the question is less whether digital assets exist and more, can this specific structure meet required standards for governance, compliance, settlement finality, and risk management. I hope I answered your questions. I see a few questions for David as well related to trade finance. David, over to you.
Thank you, Sergey. Let me pick a few. So in the first wave of DLT trade finance platforms to struggle to scale, what still needs to happen for digital assets to transform the economics of trade finance? So this is a very good question. So first wave of DLT finance was the initiatives such as Marco Polo, WeTrade. So they were using blockchain for trade finance applications. But all these didn't really reach critical mass, right? And as you may all know, these went bankrupt in the coming years, right? So technology wasn't the problem. The technology worked. It was more the client adoption and reaching that critical scale. Back in the day, they lacked a little bit this regulatory, all these regulatory frameworks that had been advancing throughout the years. The MiCA, the UK Act. So a lot of regulation that we cover throughout the paper. But I think the biggest challenge as today is interoperability, right? And also Sergey was mentioned it before. So when you look at trade finance, it's multi-party by definition, right? So you have the commercial counterparties, you have the banks, of course, but then you have the insurers, you have the carriers. So you have a lot of different parties sharing the same ecosystem, right? So until everyone cannot jump to the same platform, the solution is not really going to scale at the level that it can be really digitalized, right? And there is where the biggest economics will start to make sense, right? When we're able to have frictionless trade because we can leverage on the digital assets. There's another question on use cases that I believe it's quite related to the same topic. So let me also cover that one. It was the first one, I believe. Yep. So the question was, what uses did the team identify in trade finance beside electronic documents and smart contracts? So here the paper does an extensive deep dive right on the solutions, but it's to mention a few. So smart contracts are enablers, but the real value will come when the assets are born digital, right? So in digital assets, what we're looking is that the money is digital, that the rights are digital, the assets are digital. And there's where we can see the real value, for example, in borrowing basis. So once the assets are digital, all the friction that reconciliation, for example, puts in place, all the operational workload of reconciling all the collections or the cash positions, all the receivables that can be pledged to the collateral, all that reconciliation process becomes much easier because the asset is itself digital from the beginning, right? So that's one way that we see that it will reduce friction in the collateral space, but also it will enable what we call event trigger trade finance, right? So if the asset is digital, we have the status, we have the ownership, and this can enable real-time events. So the moment the title is transferred, you can finance the transaction, right? So this will also increase a lot of efficiencies, not only in the trade finance space, also in not only in the trade funding space, also in the letters of credit and so on. There is one question about risk that I believe Nico is going to take, right? Let me
Yes, thank you, David.
pull it out.
The question is, what are the recommendations for risk management? And I think I touched that in the beginning. The thing is that stablecoins are backed within the issuer. So if you're a bank, you have a counterparty risk, right? So you have to evaluate how big is that risk and how trustful is the issuer. And on tokenized deposits, the deposits are already in your accounts, so it is already there. So there is from a risk view, there is not real risk for you if you keep it inside. It's a total different thing if we start to see that tokenized deposits are shifted around between banks. Then you will have to decide again, and then you will have again a counterparty risk that you have to decide on. And then you will get limits, and as we know it from correspondence banking today. But as of now, tokenized deposits, as they're used only internally, they do not have risks, and stablecoins have the counterparty risk of the issuer. Yes, and I think we're at the end of the.
No, we can answer a few more. Naushad, you have your hand up. I'm going to allow you to speak. So please unmute yourself and speak if you have a question. Okay, not. If not, you can. The team wants to pick up one more question if Naushad doesn't speak.
I believe Dana wanted to take one of the questions.
Yeah, I
Okay.
can take. There's a question here about any findings on how to scale the use of digital assets. I think for this question specifically, we have to go back to regulation and avoiding fragmentation. So as regulation develops, as we get more information from the Genius Act, the MiCA, and similar ones across Asia, that will really be the framework that will grow the use of digital assets, and that will provide the scale of digital assets. We really need that framework to be clear and for big banks to start adoption in order to see the scale start to grow. I think that is the end of our Q&A. So thank you everybody for joining our presentation. We hope that you download our paper to read it in its full entirety. And yeah, thank you all.
Thank you, everyone. Thank you, team.